This is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending January 11th, 2019. It's still a couple hours to go left in the trading day. It's 2:13 Eastern Time as I'm doing this video. This is actually the second take. First take, apparently there was no audio in the video. Turns out that was a looks like the USB, one of my USB jacks died on the computer, but fortunately it wasn't the mic, so I just switched out and here we go. So I can see now audio is recording, so we should be good to go on this one. All right, what I wanted to talk on in this video, there's not a whole lot that's changed again, because it's another, we've seen that price compression. You know, I use that analogy, the Russian dolls, these candles getting smaller and smaller and smaller. Right now, as I'm doing the video, the large caps are down. QQQ is down by about 0.5%, SPY is down 0.1%, and IWM, which you're looking at here, is up slightly, about 1.15. So we'll call it a flat day as of now. But what I want to point out were a few things, and mainly I wanted to look at a trend that I've noticed recently. And again, it's only a recent trend, and that is underperformance by the market leading stocks, or at least the former market leading stocks. I'm referring to the FAANG stocks, FAAMG, Facebook, Amazon, Apple, Microsoft, and Alphabet, which is the GOG. All right, let me pull up that list what I have here. Okay, here's a watch list we're going to get to in a second with a lot of the names that I'm going to cover. Before we do that, let's just start out with the small caps. Now, the small caps have vastly outperformed. Before we get into the performance here, let's just do a quick recap on this, because IWM, it's interesting. Today, as I'm doing the video, and actually as I did the other video over 30 minutes ago, it's the same story. When I put up the crosshairs, you see the pop-up box to the left. The high of the day on IWM was 143.99. You can see right now, if you look about the fifth row down, EMA is at 144. As I did the first video, the EMA was at 143.99. Remember, an exponential moving average, or any moving average, will move with prices going up or down. So that's effectively been hit today, as I said earlier today. The exact high to the penny of IWM was at 50-day. Now, what does that matter? It may not matter as much on IWM, although it could. IWM has certainly gotten ahead of itself compared to the large caps, and I suspect, as I've covered recently, the 50-day EMAs have done a pretty good job of acting as support and resistance in the past, and it's usually that initial tag you get a reaction. So I suspect that the algos, I'm referring to algorithmic trading programs, those are the ones that fire off the high frequency trades, computerized trading. That's why you see the market fly up and down faster than you can even get in or out of a position if you don't already have an order placed, to trigger. So we'll see what happens here. And again, we'll look at the large caps, because I would consider IWM as more of a secondary or even tertiary index. What I mean by that, although we have roughly 2,000 companies in the Russell 2000 and only 500 in the S&P 500, 100 in the NASDAQ 100, of course, and the Dow 30, the large cap stocks make up by far the vast majority of the market capitalization in the market. So much fewer stocks make up a much larger portion of both the stock market as well as the economy. The earnings from Apple or Amazon or Walmart, they dwarf, many of the companies' small cap index combined. Now, the small cap companies are, because they are smaller, they're riskier. Their business models aren't as sound. They're not as well capitalized. They all have a faster growth rate, but when things go south, they go the other way. And they're also a sign of risk taking. When you see the Russell outperform, small caps outperform, usually means there's speculation in the market. Although that's just generally speaking, of course. So I'm going to get to the trends here in a second, show you some performance numbers. We're going to look at the equal weighted indexes as well as the actual indexes themselves. And before we do that, I just want to mention again, so IWM today has come in and made a perfect kiss of the 50-day moving average, and also the resistance level or target that I had. On the right side of the chart, I placed an official trade on IWM right here. As many of you know, I started getting bullish right into before the lows, saying that the risk reward was no longer favorable. On the short side, we're going to have a big reversal. Actually, if I'm not mistaken, and all the official trades on the site are there for public record. You can go into the closed trades as long as that closed trade isn't still active. In other words, if you hit a first target like this, and I have a final target here, that's a close for those that might have booked profits on T1, but still active until that's hit. And then at that point, then it moves out where anybody can access all those trades, all the posts going back. But what I'm getting at here, we were stopped out for a negligible loss. I think it was right around 2%, maybe even under 2% or just over. Very small loss because we got in just a hair early, stopped out here, and then they took us out. And of course, I was on vacation here that day. Well, it would have been a great time to add it back. And I made mention, a lot of people on the site, they gave it more room. I gave my positions a little more room, but we took out the official stop there. But the point is, there was a big green reversal, and IWM hasn't looked back. And now I set my final targets on swing trades at where I think that initial, at least the swing run will end. I've made very clear I wear two hats. I wear as an active trader and also an investor, longer term trader. And when I look at IWM, what I'm seeing here is I always set my, on longs, I'll try to cover or close it, I should say, just before the actual resistance level. So if I hover on that line, you can see the pop-up box. 143.96 is the level that I was targeting. That pop-up will show me where there's a horizontal line where I was targeting that final target there. So we effectively hit it. We went over that by just a couple pennies. And again, that's where back here, before we even bottomed, I was expecting the bounce to come here and then reverse. Now that we've hit that, which is resistance. It's not just an arbitrarily placed line. We hit the 50-day EMA, and if you look to the left here, as I've covered recently, we also, that lines up almost perfectly with the 38.2. That's why that horizontal line kind of looks dashed like these other lines. That the dashed line underneath it is a 38.2 Fibonacci retracement from the move all the way up to the highs down to the lows. So what is that? That's triple resistance. Some traders will trade exclusively on fibs. I'll incorporate Fibonacci retracement levels into my trading. But either way, that's an area that often acts as, if not the final stopping point on a counter trend rally, it will often act as resistance. So you'll probably see some traders step in there. And now let's talk a little bit about the performance here, if we can. Let me go to this. All right, so we know what happened off the lows, and what's happened so far with IWM. It looks to me a lot like, this isn't my area of expertise, but I'm somewhat familiar with Elliott wave counts. Maybe we're going to have a 5-wave up impulsive move here, the primary 5-wave cycle. That would be wave 1 up, wave 2 down. Wave 3, which from what I understand, Elliott wave is usually the longest, the most powerful wave, and so far that would meet the case for that. And so if we get a correction here, that'd be your wave 4, followed by a wave 5, and maybe time to get out. And again, we'll see how that plays out. I factor everything in. There's not any one, buy or sell signal or piece of technical analysis that determines where I trade. It's all kind of taken together. But as you can see here, these green candles, I have my candles set to show daily closing values. If I have a green candle on a daily chart, it means we close the day green, close higher than the previous day. And so you can see, other than this one candle, since December 24th, the lows right here, we've only closed red one day. It's been tremendous strength on IWM. Now, what I want to focus on here is this thrust up from this correction right here that we had. It was about a 3% or so pullback on IWM. Let's see where it was. Almost 3%. QQQ, I think, did a little better. And so far, a very powerful move. So I think the way I'm looking at it is this was the point of recognition right here. This whole thing for both those that were bearish, thinking the world was going to come to an end, and those that were waiting, to get into the market but wanted to see some type of evidence that it had bottomed. And I think it was pretty clear after that point, especially once these lows held as I expected them. I thought that would be a correction, and then we'd resume the uptrend. And so we're going to look at that point. We're going to see how the market did, or how each of these major indexes did. So what I'm going to do is I'm going to take that low from the January 3rd, that was last Thursday, and I'm going to measure it up. Since the market's still trading now, I'm just going to use, and because we're also virtually flat, I'm just going to use yesterday's highs to keep it equal on all of these as I go through the various indexes here. So the rally from low to high, again from the last Thursday to yesterday's high, was 9.39%. All right, in IWM. And now let's look at, let's go to SPY first. So the S&P 500, which you can see is still below its 50, quite a ways, and that's what I made mention before, is that when I was talking about, that this is probably the level that the algos are more interested in. Although they may, it's possible that the large caps could continue higher for a little while. IWM got ahead of itself. Maybe IWM starts to come back in first. Certainly a possibility. But this is a very well watched level, I believe. I've gone over in the past how it's acted as support and resistance. And so what I think is two things usually happens when all eyes are on a level. Um, if all eyes are on a level, you'll do one of two things. You'll reverse just shy of it, like you did back here. Let me use this tool. Or you'll pop above it, and what that does, it runs the stops. All those that go and short the 50, they get burned. When it pop above the 50, they say, oh, it didn't work. We went right through it. They get squeezed out, and then the big move comes. And the longs also, you get longs that say, oh, we broke above the 50. Things are bullish again. They jump in. Yeah, this is just my thing. I don't chase breakouts. I don't care if we go to the moon from here. I don't chase a breakout above a key resistance level if it happens when the markets or the index or security is already very extended and overbought. Because from my experience, at best, and again, the 50 is not it's not a be all end all level. It comes in roughly with some resistance, but let's just say you were targeting the 50. So at best, if we continue to rally up and break out, I think we'd at least come in and back test it before going higher. So that's why I wouldn't chase a breakout there. That's one of several reasons why. Now let's measure the performance here. So you can see same sort of, three waves so far. Your initial thrust off the bottom, corrective wave there, and a little another thrust up in the S&P 500. So to measure it out, when I click there, I snap to it. What you can see is it snaps to the bottom. I tried to snap the bottom of that candle, and it did. And then you measure to the top, and that tells me that from the lows last Thursday to the highs yesterday, the S&P 500 gained 6.36%. Now let's look at the S&P 500 equal weighted index. And I'll tell you where I'm going with this in a second. So we have from the lows to the highs, the equal weighted index yesterday was up 7.18. Not a huge disparity, but it is pretty significant. So 7.18 versus 6.36 on the SPY. That's almost a full percentage point on a 6-point move. Statistically, that's pretty significant. What does that tell me? Well, let's go to QQQ and then we'll talk about that. So QQQ, once correction set in, everyone started buying, or at least this recent thrust up where I'm noticing the divergence the most. We see from the last Thursday's lows to the highs, 7.95, about 7.95 gain. And let me make sure I did that right. Yep, 7.95, QQQ, let me write that down, 7.95. And now I type in QQQE, which is one of probably the most liquid equal weighted fund for the NASDAQ 100. And so what that's doing, of course, is taking all roughly 100 components in there, and instead applying that, very heavy overweight to those leading FAANG stocks and the top largest components, it is making every component an equal weight in the index. And so this can tell us something. What it's going to tell us here in a second, I'll get to. So we're looking at now, instead of a 7.95% gain, we're looking at a much better 8.68% gain. So what does that tell me again? That the equal weighted QQQ or QQQE has outperformed the actual NASDAQ 100 or the QQQ. Same basket of stocks, just a different weighting. So it tells me one of two. You can look at it one of two ways, but they both mean the same thing. The smaller, lower quality companies have been outperforming the market leaders, the FAANG stocks like I talked about. We're going to get to those here in a second. Okay, what I've done is dragged over. This is a list of the components of the NASDAQ 100 right here. And they're already sorted by market cap. Okay, so this column right here is market cap. Amazon is now they've been leapfrogging each other, and it's back to the world's largest company, just overtook Microsoft. Not too long ago, Apple was the largest company, the first $1 trillion market cap company ever, and look, it's all the way down here. So that's what just a few months can do in the market. All right, so what I want to show you, let's just click through these real quick. So take just a quick visual here again of QQQ. You can see we've been moving up pretty strong. Roughly, again, yesterday's highs were roughly the previous high from the day before. So what we're doing is we're not going down at this point for the last 2 days, but we're not going up. Now, when we look at Amazon, I'm going to click on these. What I see is a trend, a downward trend. It's not anything huge, but it is worth noting. And maybe this is flagging action. I would be remiss not to point that out. But it is weakness in the former market-leading stocks. They're not leading at this point in time, and they haven't been for the last week or so. So there's Amazon. Here's Microsoft again, moving down. And this really wouldn't be a bull flag because you don't have you could, you know what, I'll say you could call that a bull flag. What I was getting at here is the flagpole. You need to have a flagpole, which is a sizable move, an impulsive move leading up to the formation of a flag. So let's look at it this way, and I'm trying to give unbiased analysis here, so I'd be remiss not to point that out. That's what a bull flag would look like. And what you'd want to see is, let's say Monday, going in next week, this flag is getting long in the tooth. Can't really go down much more. It takes away, the symmetry would be broken on it. So you'd want to see an impulsive breakout above the flag and something like this. Certainly a possibility. Anything is a possibility at this point in time. So there's Microsoft. Let me clear those annotations. But again, I'm looking at the recent weakness on these market leaders while the junk, or the lower, I shouldn't call it junk, but lower quality stuff is going up. So I see a downward trend there. Not really an ideal flagpole at that point, especially because you already had a period of consolidation here. That's GOGL, Alphabet Class A. There's the other share class, obviously. That chart will look the same. Here's Apple. Apple's kind of held up. Apple just got so beat down. It's not really participating as much to the upside, but it's a little weakness in the last couple of days compared, especially to the small caps. And there's Facebook. Now, Facebook is and has been my favorite of the FAANGs recently. Just a beautiful bullish falling wedge pattern, strong, clean divergences on both the PPO and RSI, and it just recently broke out. So if I had to take my best guess at what it's going to do, it's break out. As I said, I don't take breakouts that occur when a stock is very overextended. You can see Facebook expended a lot of energy just to get up to this downtrend line. And you can see right above it, so it comes in perfectly, that 50-day moving average, EMA. It took both out, so it was intersecting resistance levels, which were taken out. But what you want to see on a breakout is an impulsive move after the breakout. Volume expansion, which is lacking here. We do not have. I posted on rightsideofthechart.com today. That's a free public post, a post about taking breakouts. What's the difference of a trade setup versus a triggered trade, and then a whole part on how to confirm breakouts with volume. So you may want to check that out. And what I see here is exactly the opposite of that. We do not see volume expansion on the breakout. We don't see impulsive price action. It's very lackluster following the breakout. So if I had to guess, I think we come back in, back test the trend line, keep the breakout successful, and then have another thrust up, something like that. But again, we can see just underperformance here compared to the small caps, and again, everything I just showed you by looking at the equal weighted and the regular NASDAQ 100 and S&P 500. Okay, and finally, just to wrap the video up, I just want to show you what tends to happen towards market tops again when you see that the leaders start underperforming. What it is, it's a sign of speculative froth. People are buying junk, lower quality names. And again, not to imply that the bottom 20 or 30 or 40, 50 stocks in the NASDAQ 100 are junk. By no means, I mean, they're still large cap stocks. But again, I showed you with the Russell 2000. And again, they are lower quality, lower tier companies than the big mega cap Apples and Amazons of the world. So what we're looking at here is a comparison. This chart goes back 2 years. And you can see in purple right here, this is QQQE, that equal weighted index of QQQ, and the white is the NASDAQ 100. So let's pull it back a little bit here like this. So when you come in here, you can see, we'll go back to this point, you can see these periods where all of a sudden the leaders start underperforming. Let me grab a tool here. So you can see right here, there's the outperformance there in QQQE, marked outperformance, considerable. And again, here before the drop, here you can see the outperformance, some big outperformance here, and again here. And that is, now that we fast forward to today, let's go back, take it back here. And if I can grab the other end, we come back here, and now you can see as I zoom in, it shows you that performance, a little outperformance, a little more clearly. And we haven't seen outperformance like that in a while. You can see as we go back here, they've been tracking pretty well, other than just recently. And again, it's a very near-term trend, so it may or may not pan out. It may be those big FAANG stocks just taking a breather after they've been run up. But what it seems to me, it's on that. I think the smart money. I talked about this before it even happened, before it even started melting down. It was a very, very overcrowded trade in the FANG stocks. Too much money concentrated. Too much. Those were overloved and overowned. Most importantly, overowned positions by institutions, individuals. And now individuals, if you love your Apple, you're going to hold on to your Apple until it poof and goes away. I just, there's a lot of people out there that will tend to do that with a company. Not everybody, but now institutions have to be a little more rational about it. If they are too overexposed in Apple or Alphabet now, when they've seen what happens, if they haven't, learned this, I've seen this cycle repeat time and time again. But this is the biggest bubble we've ever had on both indexing and the FANG stocks. So I think what we're seeing is, as we get a bounce in the markets here, the institutions are quietly unloading, cutting back on those to reduce their risk exposure, so they're not so concentrated. Because it seems to me, and I think some others now, that we've only seen the very, very beginning of the popping of the biggest credit bubble and margin bubble in the history of the world. 2007 was big. This is much bigger. The credit bubble right now, the amount of credit out there, the amount of margin debt we had at the recent highs. So whatever, we're looking again. I'm not trying to paint doom and gloom. Longer term, things probably don't look so great. Near term, I'm just looking for a mild pullback here, and then another thrust up. But I did want to highlight the fact that the market leaders seem to be lagging, or they certainly are lagging, I can tell you that right now, over the last, let's say, week or so. And again, maybe it's just a temporary trend, but if it continues, it's something worth monitoring, and we'll take it from there. So this is a market wrap for the week. We still have another hour and 20 minutes to go. I don't expect any big fireworks today, but if anything really big happens, I'll do another update. Otherwise, have a great weekend, guys. This has been Randy Finney with the Right Side of the Chart.